Welcome back, students. Now, I want to explain to you the starting part in terms of consolidation at level 3, which is at acquisition. And after that, I will explain to you intercompany transactions. Now, when buying a company, you'll always have a date which you call an at acquisition date, meaning when you are buying the company. So you'll see here that had acquired 112 ordinary shares in SAM on this date. So this is the acquisition date, 1 January 2009. It can be any date during the whole year. So that is the date, and in this case, it specifies how many number of shares did you buy. So the company that is acquiring the other one is called, like HAT here, is called a holding company. And then SAM is called a subsidiary. Right. So you will see here, HAT, which is acquiring SAM, will always show this, which is the investment, the amount that they've paid to acquire SAM. Now, what is very key in this is that HAT acquired 112 ordinary shares in SAM, right? 112, which is this number here, right? SAM, as you can see here, its share capital of 1 rand ordinary shares, right? They've got 160 ordinary shares, which means SAM. So, but HAT acquired 112 of the 160. So now, if HAT acquired 112 of the 160, it means that the percentage holding, you will take 112. Since one share is 1 rand and they've got 160, so you say 112,000 divided by 160, 112, 123 divided by 160, 23. So it tells you it's 70%. So HAT acquired 112 out of 160. That tells you it's 70%. Okay, it's 70% holding on that day. All right. So the rest of the things basically that they're giving us here, they're saying the accounting policy of the two companies they're identical. All assets were fairly valued, and HAT accounting policy in terms of the investment is at cost. Right. Now, when a company is acquiring another company, meaning when HAT acquires 112 of SAM, meaning that's 70%, HAT is acquiring what we call the net asset value of SAM. Right. Now, let me explain this thing. When you're acquiring net asset value, so I'm writing there at the bottom, value. Net asset value, it is total assets minus total liabilities. That is what this company is acquiring, right? Now, if you know the accounting equation says A, which is asset, equals to OE, which is owner's equity, plus L, which is liabilities. Now, if I then convert this thing, it can mean O. I'm saying O because it can mean that. Oh, if you want to express the same thing here, if I want to express this the same way, I will say A minus L. Remember, if I take this L here, and I transfer it over the equal sign according to mathematics, you must change the sign. This must change the sign. See, it's plus L. When I push it over or across the equal sign, it must say minus that side. So that is why I'm saying OA, so A, which is assets, minus L equals to OE. So then we can then agree that this thing we call the net asset value is the same as equity, owner's equity. Because if I do the same thing this way, it tells me that equals to equity, assets minus liabilities equals to owner's equity, right? Because I was defining what we call the net asset value, right? So the accounting equation, when you look at it, it's this way when you look at the balance sheet, okay? Which can be expressed, that's why I'm saying as A minus L equals to OE, right? So that is what is happening here. So in a nutshell, when this company buys 70%, it's of equity. They are buying 70% of the equity of the company, right? That's what they're buying, because OE is owner's equity, 70% of it. That's what they're buying. So now, when this company is buying 70% of this one, so Hart bought these shares of Sam. So now let's go and check Sam. Where is the equity of Sam? We've got the share capital is the equity. No? We've got a reserve, it's an equity. We've got the retained earnings, it's the equity. So all these amounts that are at this side, these, they're equity amounts. At that date, on this date, these were the equity amounts that Hart acquired from Sam. These ones here, right? They must exist at that date for you to use them in the acquisition date. They must exist. They must be there. So now, since we have this situation here, what we then need to do is to then look at acquisition. You will see percentage holding here. That gives you the acquisition date percentage. Okay. So now, from here, what we then say, we say, if you look at this, it says here is the share capital that we are acquiring, which is 160. The retained earnings is 80. The asset replacement is 40. These figures that I'm showing you, they come from here. Right, these are the figures when we're acquiring the company. These were the figures here of equity. Remember, equity is share capital, it's reserves, and it's retained earnings or loss. Okay, one of the two, depending on what the company has made. Now, the first step is you must distribute these amounts according to this person, which is Hart acquired 70%. So you take 160, you multiply by the 70% that goes to Hart, and it will tell you it's this one. So you do the same. 80 multiplied by 70%, it gives you this one. 40, 70% gives you this one. Then again 160. Now you are putting what we call non-controlling, 30% now. Remember, from 100, if you minus 7, you get 30. Okay. So again, you take this one, multiply by 30%, this one. This one, multiply by 30%, you get this one. This one, multiply by 30%, you get this one. Okay. Then, after doing that, you add everything. 112 plus 56 plus 28 is 196. Okay. Then 48 plus 24 plus 12 is 84. Okay. So we're at this level here. You see, there's this thing, net asset. It tells you it's 280 in total, but 195 belongs to HAT. 84,000 belongs to what we call non-controlling. They are non-controlling because someone that owns 70%, he has more votes than you, who has 30. So this one is called non-controlling, right? Now, then you come here. You say, how much is this investment? 190, you see? It's 190, this investment at cost. Now, the question will be, how much did you pay here? I paid 190 as HAT for something that is 196. Now, if you pay less for something, you see, they've paid 190, but this thing that they're paying for is at 196. Right. So, you see, it says -6. This is what we call a gain on purchase. We've paid less. We've paid 190 for something that is 196. So the difference, which is 6, is what we call a gain on purchase. Now, this gain on purchase, you'll put it here. But now, before you even put it here, you must always check this one too, this amount here. Now, you'll see in this question here, they're not saying anything about the fair value of this. They're not saying anything about the fair value of this. So if they don't say anything, there's nothing wrong with the question. You take it as it is. You leave the amount as it is. You take the amount as it is, you put a 0 here. You say it's 84 at the end. Right. Now, 190. So there's a gain on purchase of 6. Then that 6 is here because 0 plus this one gives you the one at the end. Right. Now, this 84 here and this 196, they add up to 280. You'll see. Right. Now, we're at the end now. 84 plus 190. It should give you 274. Okay. Then, because we're still at acquisition, nothing much has happened. These ones, you add the 2, say 100 plus 280, you consolidate. Now here this figure is coming from 100 plus 280. All right, it's this. Okay. Now, then from there, you put your figures here. It's 100. The share capital, it's always the share capital of the holding company, meaning HAT. You can see this thing is called HAT Limited Group. Okay. So this share capital is always the one of the holding company, which is this one here. All right. It's the share capital of the holding company, 100,000. Then you'll see here it's 60 because it's still at acquisition. It's 60 from the holding company. And then also here you'll take the 130. Here, 130. Plus, it should be, this 6 is this one here. It comes from that gain on break and purchase. But this 6 here, it forms part of the opening retained earnings. You'll see when we go on, you add it against the opening retained earnings. Okay, so it's 136. All right. Then the non-controlling, which is this figure here, is the one that now is reflected here. Okay, fine. At acquisition, things look like that for now. Let's do another example which shows us at acquisition. Here's the company here. Don Limited bought 56,000 of Sun. The Sun, 56,000. You see there are 80,000 at 100. Right. Now, how much did they pay? They paid 95,000. Okay. Now, you'll see now. Here's this sentence that now they've added here. This one, it says the directors of the parents have chosen to measure the non-controlling interest at acquisition date at its fair value of 45,000. Now, when this sentence is not there in a question, it doesn't mean the question is wrong. It means take the figures as they are. You see, don't adjust them to this amount. The significance of this statement is that if, when you do the apportionment between Don Limited and the non-controlling, if the non-controlling, they are not at 45, you adjust to 45, but I'll show you that. Right. Let's go to at acquisition. Here, 56,000 divided by 8, it's 70. Right. So you are acquiring the share capital, the asset replacement, which is the equity or not on these three, and the retained earnings. All of them, they are equity. Now, here it is. 80, you put 70% here, you put 30% there. On the 40, you put 28, 70% here, and 30% here. Of the asset replacement of 20, you put 14% here. Sorry, 14,000, which is 70%, and 6,000, which is 30%. Now, you've added this, you add that, and then this one is 140. Right. Then you go and check. How much did I pay? I paid 95,000 for this investment. 95,000. Okay. So if I paid 95,000, you come here. And then you ask yourself a question. This thing is 98,000. But how much did I pay? 95,000. Right. So I've paid less by 3. Right. I've paid less by 3. Then now you come this side. Here you've got 42. But here they said the fair value is 45. So we must adjust to 45. Okay. So from 42, which is this one, for you to get to 45, you add 3 here. It gives you 45. Okay. Now, this is what now happens. This one here is what we call a goodwill. You've paid more. We've paid 45,000, or the amount is at 45,000, that for something that was 42. If more or less, let's treat it as a payment. Let's say we've paid 45,000 for something that is 42. You've paid more, and it becomes what we call a goodwill. You'll see here how we define it here. But if the figure is positive, it's what we call goodwill. If the figure is in a bracket, it's what we call a gain on purchase. Okay. Now, here we've got goodwill. Here we've got a gain because you paid 95,000 for something that is worth 98. You get my point? You paid 95,000 for something which is worth 98. So you paid less, which is gain on bargain purchase. Now, you see, this one is positive. This one is negative. So at the end, it's a 0 here because of the 2. It's a positive 3 and a minus 3. So they end up at 0. Okay, fine. Now, obviously, when you come to this side, you add the 2. Okay. Now, goodwill, you show it here under non-current asset. Right. This 3 is this one here. Okay, is this one here. You are showing that one. Then you come here. The 50 is always share capital. We must always put the share capital of the holding company. You see, it's 50,000, which is this one. Always put the share capital of the holding company. In this case, you'll put the 30, then the 65, right, which is this one here. Here's the 30, then 65, plus the gain. Remember, I always say the gain will form part of the opening retained earnings, which is this one. Gain on bargain purchase. Okay, it's this one here. Okay, That gives you the 68. Then your non-controlling interest, which is this one. Here it is. Okay. Okay. Right. Then we move to the next example again. This company acquired 56,000 shares, which they are 80,000 at that time, and your equity is this one here. Your equity, right? And they paid 95,000 for it. Now they're telling us that the fair value now is 40,000. Okay. Let's go to at acquisition and apportion that. So this is what you bought, 80, 20, 40. Now let's go to at acquisition. You'll see they're showing us the percentage here. Now you'll apportion again that to 70% here, 30% here, 70% here, 30% here, 70% here, 30% here. Now you will see here that they've paid 95,000 for this. Now this is 98, but they paid 95, which is less. There's a gain on bargain purchase. Okay. Now here you've got something which is 42. Now here you'll see they're saying the fair value is 40, which means 42 minus 2 gives us 40,000. You get my point? Now here you've got a gain of 2, because from 42 you're going to 40. So you've got a gain of 2. Here you've got a gain of 5, sort of 3. 2 and 3 gives you this one, which is 5. 2 and 3 gives you 5 in that line. Okay. Then in total, then you've got this 135. Now this you add. So here you always show the share capital of the holding company. Then you've got the asset replacement of the holding company. And here you'll see it's 65 under retained earnings, which is this one here, plus the gain, which is this one here. Okay, that gives you 70. The non-controlling 40,000, which is this one here, the non-controlling. Okay, now let's go for another example. In this one, you'll see that sentence of fair value here. The sentence of fair value is not there. There's nothing wrong with the question. It says just take it as it is. So in this case, it's 112, and the number of shares there 160. This is what you're acquiring at that time. Then we go here. Let's do the apportionment. If it's 160 here, you've got 70% here, you've got 30% here. Then that's what it happens. You apportion the retained earnings, you apportion the asset replacement. Now you'll see here, it's 84. You don't adjust. There's no adjustment here. You take it to 84 because here there's nothing that talks about the fair value. If there's nothing that talks about the fair value, you don't adjust here. You just take the figure as it is. You say, it's correct as it is, so there's no adjustment. Okay. Now let's come here. 196, which is this one. But you paid how much for it? You paid 206. Right, you paid 206. Now, if I pay 206 for this, it means I've got a goodwill of 10. 0 plus 10 is 10 here in the total column. Okay, and this one is called a goodwill because I've paid more. I've paid more for something that is worth 196. Okay, right. Now you'll see goodwill goes here. Right, you put it here under non-current asset. This figure here will go here. Okay, so again under this you add the two figures. Always the share capital is always the share capital of the holding company, which is this one. Okay, Then here you'll take asset replacement of the holding company. Here you'll take the retained earnings of the holding company. Remember, you're not adding anything here because you didn't make a gain here. You made a goodwill. There's a goodwill here, not a gain. If there was a gain, you'll add it with this 130. Okay. Then non-controlling, which is this one. Okay. Right. Another example, you'll see now, here's the fair value sentence in this one. About 56,000 at 103. 56,000 at 103, which is at 80, the number of shares, and that's 20 and 40. Right. Let's distribute 70%, 30%. When you add everything up, it gives you 98 here. But how much did you pay? You paid 103. Okay, you paid 103. So something that is 98, you paid 103 for it. So there's a goodwill of 5,000. Then we come to this one. It says the fair value is 48,000. After adding everything, after adding this and this and this, it gives you 42. But they said the fair value is 48,000, which is what is being mentioned here. Right, 48,000 fair value for easier. Now, here's 48,000. So for me to move from 42 to 48, I need 6 here in the middle. I need this 6 to get to 48. Now, you'll see now that 6 plus another 5, because both of them, they're positive, they're goodwill. It gives you 11,000, which is here. That 11 comes here. Okay, it will be here. Now, here you add the 2 when it comes to PPE. Then always the share capital is always the share capital of the holding company. The asset replacement in this case, because we're still at acquisition, it's 65, which is still the one of the holding company. 48, which is this one here. Right. Remember, non-controlling is equity. Ne? This is part of equity. It's called equity. That is why it's lumped with your retained earnings, asset replacement, and share capital. Non-controlling is called equity. Right. Now, we then move to this one here. Now, in this one, what happens is it shows that what will then happen after acquiring the company is this one here. You acquire the company here. Right. But now, do you see here? It says 31 December. Now, you are after, it's what we call post-acquisition of the company. Right. Post-acquisition of the company. So, I will explain to you this one in the next video because I want to ensure that you understand this one as is. Okay.